Good morning, ma'am. Good morning, classmates. Our report title is Cost Volume Profit Analysis and Profit Planning. And the topics that were assigned to me are example computation of break-even point in CBP relationship, multiple product setup. Number 3 is role of cost structure in CBP relationship. And the last one is operating leverage in CBP relationship. So since that Ma'am Anna is already explaining the concept and definition of CBP analysis and break-even point, in my report, I will explain also the computation of break-even point using different methods or approach. So number 1 method is equation methods or algebraic approach. The formula for this is sales minus variable cost minus fixed cost equals profit, or sales equals variable cost plus fixed cost plus profit. This sample problem is company A produces and sells a single product for 100 pesos per unit. The variable cost to produce and sale amount to 75 per unit, while the fixed cost amounted to 20,000. So let X the number of units to be sold to break even, where at break even point profit is 0. So since in break even there is no profit and there is no net income, there is no net loss, so our profit is 0. So 100 selling price equals 75 variable cost plus fixed cost 20,000 plus 0 profit. So we will transpose the 75 in order for us to get the contribution margin na 25 per unit. So 100 minus 75 equals to 25. So this 25, ito yung contribution margin per unit natin. So 20,000 fixed cost divide by 25 contribution margin per unit, we will get 800 units as our break-even point in units. So in our break-even point in peso, 800 units, we will multiply 100 selling price equals to 80,000 pesos. So this is how to compute the break-even points in units and in peso using equation method or algebraic approach. Then the next approach is contribution margin method or formula approach for single product break-even calculations. This is the two formula. So sales in units, fixed cost over contribution margin per unit. Next is sales in peso, fixed cost over contribution margin ratio. So we will use this two formula for our sample problem. Bicicleta Corporation has just increased its manufacturing capacity to enable it to introduce the new models of bicycle which it could not produce in the past due to capacity constraints. For the coming period, Bicicleta is planning to start the production of a new model which could be the Pambundok bike. A recently concluded feasibility study on the new model showed the following results. So, for selling price 4,400, variable cost is 2,640, and the total fixed cost is 3,696,000. And we have 3 questions here. Number 1 is what is the contribution margin ratio? Next is what is the peso break-even point of Pambundok bike? And the last one is what is the break-even point by units of this new model? So, using this formula, we will answer these 3 questions. So, this is the application. For number 1, selling price is 4,400 less variable cost 2,640. So, we will get the contribution margin units 1,760. So, since that the question is asking for contribution margin ratio, so we will divide this 1,760 to 4,400 selling price to get the 40% as our contribution margin ratio. So, ito yung answer for number 1. And for number 2, we are looking for break-even point in peso. So, fixed cost is 3,696,000 over contribution margin ratio na 40%, we will get 9,240,000 break-even point in peso. So, answer for number 2. And for number 3 questions, fixed cost is 3,696,000 over contribution margin in unit na 1,760. we will get break-even point in units for 2,100 units. Then, the next approach is multiple product setups. So, or multiple products or service break-even calculation. So, kanina, one products lang yung gikumputan natin ng break-even point. For this time, we will compute more than one products or multi-products na yung i-compute natin yung break-even point. So, when a company manufactures and sells more than one product or a multi-product company, the formula in getting break-even point is a little more complicated than that a single product company. So, kanina kung medyo madali yung computation natin for this time, medyo mayroon na siyang complication, kumbaga. In computing break-even point in multiple products, the sales percentage of individual product in the total sales mix should be determined. And these figures will use in computing weighted average selling price and weighted average variable cost. So the two formula are fixed cost over weighted average contribution margin ratio, and the next formula is fixed cost over weighted average unit contribution margin. So, mapapansin natin, kanina contribution margin ratio lang, unit contribution margin, but ngayon, meron na siyang weighted average kasi nga, we will computing more than one products, no? So, the sample problem is a company sales product X, Y, and G. Data about the three products are as follows. So, selling price for X, 100, Y is 120, G is 50, variable cost per unit is 60, Y is 90, and G is 40. So, the contribution margin, 40 for X, 30 for Y, 10 for G. Then, the sales in units given is 1,000 for X, Y for 2,000, G is for 5,000. So, equals the total of 8,000 units for these three products. And the total fixed cost given also is 101,680 pesos. So, my question for these problems and or activity is, number 1 is what is the company break-even point in peso? 2 is compute the company break-even point in units. And the last one is show the break-even sales breakdown. So, in applying the formula, number 1 is, ito na nga, X, Y, and G. Sales for X is 100,000, Y is 240,000, and G is 250,000, the total of 590,000. Then for variable cost, 60,000 for X, 180,000 for Y, G is 200,000, the total of 440,000. Then the contribution margin for each products is 40,000 for X, Y is 60,000, and 50,000 for G. The total of 150,000. So, the weighted average contribution margin ratio, so, total contribution is 150,000. Total sales is 590,000. Ito nga siya. So, we will get 25.42%. So, in computing break-even point in peso, we will use this weighted average contribution margin ratio. So, fixed cost is 101,680 over 25.42% na weighted average contribution margin ratio. We will get 400,000 pesos as our break-even point in peso. So, this is the answer for number 1. And for the next question is the break-even point in units. So, weighted average contribution margin, total contribution margin is 150,000 over total units of 8,000. So, yung answer natin is 18.75 units. So, the break-even points in units is for fixed cost is 101,680 over weighted average unit contribution margin of 18.75. We will get 5,422.93 units. So, yung answer ng number 2, ito siya. So, in number 3 question, they're asking for the breakdown of the break-even sales. So, since that in yung break-even point in units natin is 5,423. So, ito na yon. Yung per product X, yung break-even peso sales nila is 67,800. For product Y is 162,720. Per product G is 169,480. So, i-divide natin yan by selling into their individual selling price. So, ito na yon. Divide yung product X is 100, yung product Y is 120, yung product J is 50. So, we will get break-even points in units. Each product is, for X is 678, per product Y is 1,356, and per product G is 3,389 units. So, same way sa other computation, we will use also the percentage of break-even sales each product. So, ganito yun siya. Yung 12.5% ng products X na percentage niya sa break-even sales, i-multiply lang natin dito sa 5,423. So, makukuha natin yung, we will get 677.87 for X, then for Y is 1,355.73, for G is 3,389.23. So, actually, dito, gina-round off lang ito, then, pero same ano lang yan sila. To sum up all this amount, or all this value, we will get 5,423 pa rin na total. So, yan yung answer natin for number 3. So, the next topic is the rule of cost structure in CBP relationships. Refers to the combination of variable and fixed costs that it incurs amount of profit that a company generates is affected by its cost and the volume of productions. And this relationship called as cost and volume equals profit analysis. In choosing the structure of the cost for the company can help us to understand the value of fixed and variable costs on which is used in determining the proportionate amount of fixed and variable costs to total cost of the company. CBP analysis, it examines changes in profit in sales, volume, and prices, and determining on how the changes in variable and fixed costs will affect profits. This analysis also is used to ensure information for planning and decision making, such as choosing problems during planning or forecasting of products for sales and profit maximizing. So, in addition to that, in CBP analysis, it provides the contingency of planning, control, and company's financial result achievement. And it shows the illustrations of the relationship between costs, revenues, and profits, and are used for comparison of the actual profitability, comparison of profitability in different time periods, comparison of actual revenues, costs, and profits, and showing the impact of various factors, variable costs, fixed costs, selling price, volume of activity, and product mix on the plant size. So, let's move on to the next topic, the operating leverage in CBP relationship. So, operating leverage is the extent to which a company uses fixed costs in its cost structure. Leverage is achieved by increasing fixed costs while lowering a variable cost. So, operating leverage factor OLF or degree of operating leverage DOL used to measure the extent of the change in profit before tax resulting from the change in sales. So, there is a formula for in getting the operating leverage factor OLF. So, DOL or OLF equals to total contribution margin over profit before tax, or percentage change of profit before tax over percentage of change in sales. So, in other words, in the operating leverage is in a cost accounting, that is the measurements or measure the degree to which the firm or the company increase its operating income by increasing their revenue. So, let's use this in our sample problem para mas maintindihan natin. So, following is the company results of operation from its present sales level of 10,000 units. So, sales 10,000 units at 5 is 50,000, variable cost 10,000 at 3, 30,000. The contribution margin is 20,000. Then the fixed cost is 12,000. Profit before tax is 8,000 pesos. So, compute the operating leverage factor or DOL based on the given financial statement above. So, this is the application. So, OLF or operating leverage factor is total contribution over profit before tax. So, 20,000 for total contribution over 8,000 na profit. So, we will get 2.5 OLF factor. So, we will use this one para makuha natin yung computation na 25%. So, follow-up question. If the company sales would increase by 10%, its profit before tax would increase by 25%. So, to prove, so 10% daw yung increase ng sales, we will multiply it to 2.5 yung OLF factor natin. So, we will get 25%. So, tama yung proposed percentage nila sa profit nila. So, ito yung proof. For sales, sa present daw is 50,000, variable cost is 30,000, so contribution margin is 20,000, then fixed cost is 12,000, so the profit is 8,000. So the proposed sales, ito daw siya. The sales daw is 55,000 and variable cost is 33,000 and the contribution margin is 22,000 pesos. Then the fixed cost is 12 and the profit is 10,000. So note that yung variable cost is called as a relevant costing. So meaning whatever kung ano yung flow ng sales, yun din ang flow ng variable cost. So yun nga ang tinatawag siya na relevant costing. And unlike sa fixed cost na kung ano yung flow ng sales, not affected siya. So, because the amount of fixes is always remain constant. Yun siya. So, showing the percentage of change. So, in sales, the increase is 10%. So, 5,000 is the amount. So, ito yung change, change percentage niya. So, yung difference na 5,000, lang natin siya, i-divide into 50,000, so we will get 10%. Same way sa profit, the increase, amount is 2,000, then divide to 8,000, we will get 25%. So, ito na yun. Yung sinasabi nila na, change of, kumbaga, increase ng percentage nila ng kanilang of the profit of the company. Yan. So, 25%. And this is all my reports. And my references is this one. It's my references. And thank you very much. And good morning again.